Are we ready?
I think we're ready.
Yeah.
Let's go. So, hello everyone. Thank you for turning in. This is Up Your Savings Part 2, a follow-up seminar about savings. We had a previous session earlier this year where we went through the foundations in savings. And today we are going to go a little more into the depths, I
Yeah.
think. My name is Henrik, and with me I have our saving specialist, Filip Koltze.
Thank you
And
for inviting me.
well, thank you for for having this with me. We, all of you viewers, you can ask your questions in the Q&A function here in the webinar, and we will have people answering them during the webinar. We will also pile up some questions that we think are relevant for everyone to hear and answer them at the end of the session.
Yeah. Hopefully we could answer some questions along the presentation.
Yes. So, without further ado,
We're ready. And we should, of course, address the first picture you see here with me and my colleague Felicia. She couldn't be here today, so I'm very grateful that you are here instead. Perfect sidekick, I think,
happy to be here.
because you are the pension specialist.
Uh, yeah.
Yeah. So let's start. As you said, we had this webinar earlier this year, and it was Felicia who presented then. And I think also you can see it afterwards. So if you want to see that again after this webinar, feel free to do that. And in that webinar, also an hour. We covered this kind of topics. Or Felicia talked about short or long-term savings, and I think in this perspective, talking about occupational pension, for the most of our customers, it's a long perspective, right?
Yes.
Could be short, but what is a short term? That could depend.
Yeah.
You could be like 60 years old, have occupational pension. It's 5 years until you are going to start to catch the payouts. And I would say 5 years is a long term too.
Yeah. A lot of things can happen in 5 years.
It could actually. And then Felicia also talked about the 3 golden investment rules. I'm actually going to present to you today a 7 golden investment rules. So we'll come back to that a bit later. She also talked about fund allocation because on Avanza you can invest in all the funds we have on the platform, and they are over 1,000.
1,400, I heard
1,400.
yesterday.
Yes, and that's too many for you to have in your portfolio. If you want them all, you can go catch them, but I don't think that's necessary. So she talked about that. She also talked about fund fees. We're gonna show that in a graph later on today. What the fees does to your savings if you didn't catch the right fund. And also, of course, the best habit of your life, except from going to the gym or everything else that you can do that it's good for you. Monthly savings is a perfect habit to gain long-term results on the stock market or even if you invest in funds. But today we're going to focus on this. Your fund portfolio, is it good enough? I think this is a question that I know that I tend to think of. Do you think of this
Yeah, so do
question?
I.
Yeah. Even if you are, so to say, expert, this is something, depending on how the stock market is developing, I think everyone is thinking about this one or twice every year. And we should start off by asking ourselves, what do you aim to evaluate? What is the purpose? It could be from this different perspective, the diversification. As we said, how many funds should you have in your portfolio? If you have two funds that invest in Sweden, you have a diversification of several companies, but not on several markets. It could be the level of risk, depending on when you want to take out the money from your occupational pension. If you're close to the pension year, so to say, you may want to pull back the risk. And if you have, like me, I'm 35 years old. How old are you?
32.
32. So you have even more years than me. And then you can have a higher level of risk. Fees we already talked about, and we're going to come back to that. Return, of course, that's probably the most important thing. And every time you look at a fund, when you see a return and you want to compare a specific fund's return with another, you can always be sure that it's after the fees. So you don't have you don't need to compare the fees when you look at the return figures. Impact ESG, obviously a very important question for many of our customers and also for us working at Avanza. We have developed a lot of features in this area the last couple of years, and I think we're going to do more in the future. So if we talk about the level of risk in funds, the first main topic, you can see in this chart that from the very bottom, you have the fixed income funds. And depending on if the fixed income is a short-term one or if it's a long-term one, that defines the level of risk. And when you go higher up this, we can call it ladder, then you will see that the purple ones, they are the equity funds. And in the middle, now it's in Swedish, blandfonder, that will mean a mix of equity and fixed income. And the more narrow the equity fund is, if you invest in a specific topic, like it could be tech funds, that would be the highest risk comparing to investing in a specific country. That would be less risk because you don't have just one industry in that fund. So I think this chart really shows you what you need to have in mind when you are setting your goals, thinking about when do I need my money, how much risk am I willing to take. And if you have a very long time span, then it's okay for you to take more risk. Do you have a lot of risk since you have so many years left?
Well, I think that is actually a really good topic. One thing we can see with occupational pension is that a lot of people usually don't have maybe the optimal risk as they should have. For some reason, people are afraid to touch their pension, so they have their private savings and there they go full all-in risk. But for some reason, with their pension, they shy away a little bit and take some medium risk level. So I think this is something that is good to think about, really.
Yeah.
And what you just said, that it is the long term that should decide, or should be one of the aspect that should decide what level of risk you should have.
Of course, and the occupational pension, it is your money, as the same money you get from salary and you put in on a ISK or any other savings account just today. The only thing that differs is that the occupational pension you can't take out before you are 55 years old, right? So it's the same kind of money, have the same perspective with this money as any other. Here we can see the risk and return go hand in hand, and we give a few examples here. When you see Avanza Auto, we have 6 Avanza Auto funds actually, and they are from one, it's the one with the less risk, you have more interest rates, and if you are on 6, you have 100% equity. And this chart actually is a perfect example because this is exactly what you want to see. This is from mid 2019. So say it's a 5-year chart, and I think that's a perfect period to evaluate funds. And you want to see this. If you take more risk, you will have more expected or higher expected return. It doesn't mean that it will always be like this in every 5-year period, but this is what we expect. And moving on to index funds versus actively managed funds, it's a really big debate between those two, and I think it's from two perspectives. First of all, there's a lot of research that shows that actively managed funds, they as a group doesn't beat the market or beat their index, because that's what they are about to do. You invest in an actively managed fund because you want them to beat a certain index, in opposed to as an index fund, they just want to follow the index, and you're gonna get the return of the index minus the management fee. And this shows that we have one index in here, and you have 5 different, or is it 6, 7 different actively managed funds. They do differ. And I would say that if you want to invest in an index fund, it doesn't you don't have to follow it up as much as you do have to do with the actively managed fund, because then you really want to see, because you are paying for alpha, which is any return that is over index, and if you don't get that, you're going to get less money than you would have in an index fund.
So basically, one should be aware of what you're actually paying for when choosing an actively managed fund, and maybe once in a while see, okay, is this actually worth it? Am I getting the return according to how much I'm actually paying for a certain fund?
That's a very good summary, and I think you could do it like once a year or something, but you also, if you have invested in an actively managed fund, you need to give them time, because you want this fund, if it is an equity fund, you want it to overperform over longer periods of time than 1 year. It could actually be that 1 or 2 or 3 years they're gonna lag the index, but you want to invest for like 5, 10, 20 years, and that's the period you should evaluate. But if you see that at a fund that is actively managed, if they underperform year after year, maybe you should think about why that is. And speaking about the fees, this shows very perfectly what the fee, a rather small fee, can do with your money over long periods of times. Here we have 2 examples. It's accumulated fee of 0.7% and a 0.2% fee. And here we can see both of them, I mean, they're both below 1%, so it feels what do you say, naturally as a low fee, but over this time span, you see on 40 years is a really big difference, and yeah, it's kind of shocking actually.
Yeah, how such a small figures can have such a large impact
over this time. It's the compounding effect reversed, so to say, or because you want on returns, this effect over years, the compounding effect is on your side, but the fees are not on your side.
So how you could think about is that the thing, what you pay in fees, that could be something that you rather could have invested.
Exactly.
And so basically you lose out on that capital.
Exactly. But as we said in the beginning, when you are evaluating returns of a fund, the fee is always included. So if you have a fund that performs 12% a year, that it's costing more, that will for that year be better than an index fund that is performing 10. You will get more money even though it costs more. But you need to follow up so they do their job. And another thing that is very important when you are evaluating your fund portfolio is to compare apples with apples. And we are not talking about the stock here. We are talking about the fruits. And you have actually great tools in the app or on the web to do this. So you can compare a fund, the actively managed fund, with the index fund that is investing in the same region, for example.
What could that be, for example? So let's say that I have uh, two mixed funds. Is it important that I actually look at, okay, are they investing in different regions,
Yeah.
or is it that kind of comparison you should do? So you not compare, for example, a global fund with a US fund, for example.
Exactly, because you can see, I know a lot of our customers, they like to see the charts, the top charts of which kind of funds that are the best for now. And I think if we go back like 20, 25 years, India funds have been the best category. And then you can't compare an India fund with a European one or a US. You need to compare India with India. Of course, you can compare them return by return, that you can see that okay, India has been the best market to invest in for the last 20 years. Maybe you should have been there, but you can't, especially with the actively managed funds. If you have a fund manager that want to beat the market in Sweden, for example, you should compare that fund manager with another one that is trying to beat the stock market in Sweden. That's apples with apples. And this is another one where you can see the widely spread with managed actively managed funds. I think these are 4, 5, 6 funds that invest in the same region. And as you can see here on, I think it's a 3-time period, you have a very large spread of the returns that these funds have given their shareholders or fund holders, so to say. If we're going a bit deeper, this is a sort of advanced sort of a advanced figure. We call it risk-adjusted return. That is more commonly known as the Sharpe ratio. And here you can see where you can find this under analysis. And I think this is a great figure because it shows what kind of return have you gained compared to the risk you have taken. So if you compare two funds with each other, remember apples with apples, you can also see have they performed this well with what kind of risk. Because if you are taking a lot of risk, investing in papers that are with a high volatility, because that's how we define risk, there you should actually get a high return. But if you don't get high return, you have put your money with a lot of risk and you don't get anything back. So if you have a high Sharpe ratio, it's very good for you. And we usually say that everything above 1 is really, really good. And if you have a half to 1, that's also okay. What Sharpe ratio do you have?
That's a good question. That I'm going
We need to look it up afterwards.
Look it afterwards, yeah. Use our great tools that we have available on our platform.
Exactly. And of course, there's a lot of more tools to analyze your portfolio. Here you can see under analysis too, how many regions you are invested in, what the weights are between those, how much are in the US, how much are in Sweden, and so forth. And also what kind of industries that you have invested in. In this example, there's a lot of finance, you have a lot of tech, and also healthcare. And it could sometimes be hard to see if you invest in 5 different funds, how this would be in an aggregate view. So that's what you can see here. You can also see, of course, the average fee, because if you have like 5 funds, may have one or two that costs more, and the rest of them cost like an index fund. You can see the average fee here, and I think that's the most interesting one to look at. Also, the average rating from Morningstar. I think, or I know that it's a very popular tool to follow. Which of those do you think is the most powerful, or the one that you follow up on most?
Which one? Sorry.
Yeah, which one of those tools do you like to follow up on most? Is it the average fee, or do you want your portfolio to have the maximum amount of stars?
I actually go after the highest fees usually.
Okay,
That's where I usually look at of by habit.
yeah, you
But
want
there's
them to be
something.
low.
Yeah, I want them to be low,
Yeah,
exactly. And uh, personally, I have not rate well go for after the rating that much actually.
no.
Maybe I should.
I think there's also a problem with the rating because here you actually really, really want to compare apples with apples. We can say green apples with other green apples because you can have a fund that is performing better than another one in another similar category. But these ratings will be given out to the best performing funds within a certain category. Makes sense, but it could be that if you are comparing one fund that has 5 stars, it would be that it's one of the best within that category. It could be that another fund is actually performing better, but it only has 3 stars because it's in within a category that is performing better as a whole. So understand your stars before you're evaluating them. And of course, you can see the fund holdings. It could be interesting to see what the fund manager actually is investing in. And here is probably, or it is Avanza Global. As you can see, it's only American stocks in the top. I think this fund has, as almost every global fund has, about 70% of American stocks.
Speaking of this, when we see what we are exposed to, something that I usually find with our customers is that they usually invest in funds who has the same
Yeah.
rate, same. So then I think maybe it's way more important to actually okay, maybe you should compare those two and choose one who you think are the best after maybe looking at the ratings and the fund fee or what it could be.
That's a very good point. So if you have two funds in your portfolio that looks quite similar, and you can evaluate them with the tools that we already presented, and I would say choose one of them and choose the one that is the cheapest if they to you looks to be the same, and up your portfolio with another one that gives you another market or another kind of exposure. Very good point. There is, of course, a lot of fund information that you could also read through. There is a fund fact sheet. You have the benchmark index. You should, of course, look up the fund manager because basically you are giving your money to this woman or man that's going to manage your money. So look who it is and see if the fund has changed their fund manager in the recent years. It could be sometimes that a fund have performed very well, and it's mostly because of this fund manager that has done a good job actively managing this fund, and then that manager will be traded to another company. Then you want to see, and you can actually see here under fund manager which date they entered. So if they entered just like a month ago or something, maybe they need more time to show what they go for. This is not actually so important if you are talking about index funds because the only thing that they do is replicating a certain index. And this is often the most interesting picture to show because this shows us and it shows you how other customers invest. And this is I think particularly within occupational pension. And as you can see here, our own funds are very popular, and we thank you for that. But there is another trend here too, and we can see that it's a lot of focus on Sweden and it's a lot of focus on global funds.
Before we move
Mm.
on from funds, we actually got a question I think is quite relevant. And it is in ISK, well, it doesn't matter really what kind of account it is, but let's say that you have your fund portfolio for 1 or 2 years or even more. And then, of course, those funds develop. Some increase in value and some decrease and so on. So from the initial percentage, you will over time have a completely different percentage of your
Allocation.
allocations.
Yeah.
So the question is, so how should one rebalance it? And is it a good way in doing that at Avanza today or something coming?
I hope it's upcoming. I've been talking about this internally, and I think that we should develop that kind of feature. I don't know if they are working on that, but I
I
hope
actually
that.
do know that
You
they
do
are
know.
working, but
Good.
nothing done yet.
Okay,
But
great news.
there's good news.
So, but since we don't have it today, I think you should do this like maximum one time a year. You can have it after the new year or when your birthday or whatever. Just mark your calendar once a year and look over your portfolio. And if you have set a certain allocation between one, two or three or four or five or 10 funds, and they have gone away with different kind of returns, reset that one by changing, because you don't have to sell and then buy again. You can always click on change or byt in Swedish. So it's quite easy, but don't do it too often because that takes a lot of time, and I don't think that's kind of necessary. Looking forward to that feature.
Yeah, me too.
It's going to do it for you, hopefully. In this next episode of or next part of this webinar, we're going to talk more about stocks. This is my lovely part of this. The first one is more close to heart with Felicia. I hope I did it kind of okay, but now we're going to talk stocks because I think this is one of the best things about having the occupational pension at Avanza is that you can invest directly in stocks. It's not every platform or every kind of occupational pension structure that you can do that in. So if you love stocks, this is great for you. And I'm going to go through 3 points that I think you can argue that stocks are in favor of funds. And the first one is lower management fee, because when you are buying a stock or selling a stock, you are paying a commission, and this commission is just withdraw once. And so if you buy a stock today and you hold it for 40 years, it's going to be a very low management fee. And here we have the problem that many of our customers aren't that long term with their investments, so they buy and sell too often, and it gets a higher management fee probably than if they would have invested in a index fund. But you could get a lower management fee by investing in stocks. You can also pick and choose whatever you want, and I think this is maybe one of my most favorite thing about investing in stocks, because when you are investing in a fund, you are buying this whole bag with a lot of ingredients in, and maybe you like the most of them, but it could be one or two that you are not liking. And when you are investing in stocks, you can pick and choose exactly how you want it. So I think that's also something that puts stock in favor of funds. And also the opportunity to take higher risk. And I don't want you to take too much risk, of course, because this is your pension money, and it's your future salary. And but if you have like 20, 30, 40 years left until you need this kind of money, you can take higher risk if you are willing and confident with doing so. And now I'm going to present the golden rules, the 7 golden rules according to the Swedish Shareholders Association. So they're not mine. I copied those, but from a good and trustworthy organization. And the first of them, the first one is long-term goal, and that's we can put a checkbox for occupational pension because, as we said in the beginning, most of us have a very long-term perspective with this kind of money. You should invest regularly, and that's preferably every month. And I think if you have your occupational pension at Avanza, your money will come into your account every month.
That's correct.
Or is it any exceptions? Could you have it like quarterly?
There are some small exceptions, but generally you receive it by the end of the month with 1 or 2 days difference sometimes, depending on weekdays and so
That's
on.
perfect. So you invest in the stock market or through funds 12 times a year. That's awesome because you don't have to think about where the stock market is right now, because we can see where it is right now, but we don't know where it's going tomorrow. So invest regularly. You don't have to think about the timing issue. Next one is control the risks, because investing is taking risk. You can't take away all risk, because then you will get no return at all. And I often say that that's the biggest risk you could take, because you won't return on your money over time. And there's 2 types of risk that I want to elaborate on here. It's the company risk, and the company risk is you invest in a certain tech company, and that certain tech company isn't doing well, but the industry or the sector is doing perfect. That will be the company risk. And then you also have the market risk. And the market risk is that if something happens in the world, it could be a war, it could be, inflation rates, it could be just anything. The market could crash, even though the company that is on the stock market is performing really well. So those 2 risks you need to have in mind. The Swedish Shareholders Association says that you should stay well informed, and this is particularly when investing in stocks. You need to stay well informed. They say that you can pick 10 to 15 stocks, and you should divide them between 5 or 6 industries. And the level of stay well informed could obviously vary. Me, as in my job, I read the newspapers every day. I see all the news feeds, so I stay pretty well informed. But it is an overload of information, and I understand that if you're not working with this, you can't read through every time. But if there is a report coming from a company, read that through and see if the company you have chosen is still doing well.
We actually got a question I think is relevant where we are right now,
Yeah.
and I would say that this goes to maybe market risk. The question is goes like this: I'm still more than 25 years away from using my pension, so I think about the long-term risk associated to climate change in the next few decades.
Yeah.
How is this taken into account? I'm thinking sunken fossil fuels reserves, climate disaster affecting industries, health, etc.
That's a very good question. I think that this perspective is maybe the biggest trigger why ESG investment is so popular. We can see that on the fund side, and we can also see it with stocks, even though it's kind of harder with stocks, because in the fund you have the fund manager that is doing the selection, and they have more data, more analysis power to see what kind of stocks have more or less ESG risk. But I think if you have this kind of perspective, you should take that into account if you're worried about it. If you don't think that oil companies are gonna have a business in 40 years old, or in 40 years, why invest in them today? Maybe they can turn around their business and do something else. I don't know, and I don't say that you shouldn't invest in oil companies, but that could be an example of how you can think about this. You have a very long-term perspective, and of course you should not think about what kind of companies should I invest in today that gives me return in 1 or 2 years. Think about this 25 years perspective. I think it gets a lot easier too to evaluate different companies and pick and choose the ones that you really think are going to do great. But it's very hard. And this actually comes into do your own analysis. There are a lot of experts in this market that says you should do this. I think this is going to perform best. I don't think this is going to perform that well, and so on. I think that you should do your own analysis based on that. No one in this industry knows about what's gonna happen tomorrow, in 5 years, or in 10 years. The only thing that I am certain of is that the stock market is going to continue to climb and be a great place to invest in for the long term. Because if it doesn't, we're going to have a lot of bigger problems than that our money has gone down in value. But do your own analysis and believe in yourself and your own competence. I think that's key here. And of course, be conscious with leverage. It's not that big of a problem in occupational pension because you can, of course, buy funds that have leverage within them or other kind of investment products, but you can't take a loan and put it on your account. So not that kind of big a deal here.
But you can do on other types at accounts.
Yeah, like ISK and so on. And that could be rational over long periods of time, because if you think that the stock market is going to go up in 20, 25 years or even 5 or 10, if you're adding a little bit of leverage to that, you can get more return than if you didn't. But as soon as you put on leverage to your account, you could go bankrupt. That means all the value has gone away and you're still have to pay back this loan. So that's always a bankruptcy risk. And we already talked about this, set rules for when to rebalance. I say once a year is perfectly often. And then you think about how your stock portfolio is doing. Here I compare the OMXS30 gross index with Avanza Global. That's comparing apples with peers. And I'm doing this just to give an example of how you could compare your portfolio. The first one, or the first question you have to give yourself: are you beating the index? Because you don't actually you could have that as a target. I want to beat the index. That's why I want to choose the stocks by myself. But it doesn't have to be like that. And if you are lagging index, it could be the case that you think that it's okay for me to lag the index because I have chose my own portfolio and I don't want to invest in a fund that has certain investments that I don't like. So you decide. And this is why I compared a fund with an index in this chart, because I think it's mostly common to compare your portfolio with the index, but the problem with the index is you can't buy that index. You can buy an index fund, but then you get the index minus the management fee. So if you are comparing with another fund instead that maybe you should have bought if you didn't pick and choose your own stocks, it could be more relevant. And I already answered to this. Do you have to beat the index? Yes, if that's your goal. But if you have another goal in mind or another preference, go with that.
Question from me regarding this. Is it relevant to actually maybe to think about, okay, what index is I'm actually looking at, speaking of comparing apples with apples and so on?
Of course. Here you have the OMXS30 GI gross index. All the dividends has been reinvested. Here we're looking at the 30. most traded companies in Sweden. And that, of course, it's a lot of industry, it's a lot of large corporate banks. And if you have a portfolio with, say, more smaller companies in other industry, maybe you should look at an index that covers the whole stock market in Sweden. So I think actually in the US there are more indexes to compare with than there are products to invest in. That says a lot.
Interesting.
Yeah. And if it is the case that you are behind the index and you feel really frustrated about it, you need to dig deeper to understand why is this like that. And here in Sweden, if we look at this is a chart that shows that real estate and tech have been really bad industries to invest in the last couple of years, while industry and banks are in top. And this could differ, of course, what kind of market you are looking at. But we see that our customers in Sweden, they tend to invest in stocks in Sweden, preferably. And if you are buying the index, you will, because the index are weighted after the market capitalization. So if you have a real estates and tech that are going bad on the stock market, they're going to get less weight in your index fund. But maybe you have allocated your money, the same kind of amount of money in real estate as you have in the industry or the finance or one of the industries that are in top. You're gonna lag index. So dig deeper to understand what have drive the index. And we can see this with an example from the US that explains this even more. In red here you have the S&P 500, that is 500 stocks in America, an index that is very well known and many compare with this. And then you have the MAG 7 that during this period have gone almost exactly like the S&P 500. But then in green you have Nvidia, and Nvidia has gone for this period like 365% in return. So they have given not all the return, but most of the return to this index. So you have an index with 500 companies, but there are a few tech companies that are giving them the whole return. So then you can think about how much diversification do you have in such a large index. Then we could dig deeper to the finances and see for a specific company. Maybe you see that you have a real estate company that isn't doing so well in your portfolio. You may want to dig down and see how are they doing. And you can see this under the analysis in our app or on the web. And here you can see how much their revenue are, how much are their sales, how is the balance sheet looking, and you can dig down to see the key financial ratios. You have the price earnings, that is a very popular key figure to evaluate, and you see those back a few years, both on a yearly basis, and you can also see it by quarters.
And just to clarify, all this data, this is something that is available
For everyone. Yeah.
Without any additional charge.
No additional charge. You have a lot of information here. If you just have an account on Avanza, just log in and all this are provided for free. And many of our customers like to invest in dividend stocks. That's stocks that they take a part of their revenue and they give it out to their shareholders instead of reinvesting it in their company. And here you can also see how much dividend they are paying out, and also if there is any growth in their dividends the last couple of years. Very interesting. And of course, we should give you the most popular stocks that are occupational pensional customers are investing in. And I think these are real, they are very common. I think you know most of those. But if we are comparing this list with all of our customers, there are more American stocks here. And we can see it's a Microsoft, it's Tesla, and of course Nvidia. And I think that's quite interesting that with this kind of money, you are more eager to invest outside of Sweden than you are with your whole portfolio. I think that's it. So now it's a Q&A session with not Felicia and Philip, but Philip and Henrik.
Yeah, and I actually think we got a question here. Well, that is fitting when we speak about different securities and countries of origin. One question we usually receive regarding pension is if you are a US person and if whether you can invest in American stocks and basically what you can invest in. And there are some difference there. When regarding bank products, as we usually call them, like an ISK, for example, you are not able, unfortunately, to open one of those accounts at Avanza. But your occupational pension is an exception. And as long as you work and live in Sweden, you are able to invest in the Swedish stock market, and also funds. And even funds who have, now my English vocabulary is bad, but exposure to US American stocks. So, for example, Avanza Global is an example of that.
Or Avanza USA.
Or Avanza USA, that's right, yeah. But as soon as you move back to the US, you will be able to keep those kind of funds, but you will not be able to buy additional, how do you say it? Additional...
Yeah, we can say shares or...
Shares in that specific fund. So that is something that is good to be aware of if you happen to be a US
There is one perfect solution to that: never move back.
Yeah.
Stay here in Sweden. The best country in the world, maybe.
Yeah, maybe.
So never leave. Good question.
Then we had a question regarding difference in savings between genders. We had a picture before.
Yeah.
Let's see.
I can go back.
And the question was, since occupational pension is a percentage of salary, is this an indicator of the gender pay gap?
Yeah.
And I would say...
Really good question. I would say that probably yes. Because you can see here that the monthly savings are 3,200 kronor overall, and they are slightly higher for men, 3.5, and 2.5 for women. So it's 1,000 kronor in between.
But we can also see it doesn't have to be occupational pension. We can see on our data that it's still a difference in how much
they're putting in from their normal salary.
From
exactly.
the private savings.
Yeah, exactly. So we have a gap there, and that we want to remove, because we can also see that our women, our customers that are women, they tend to get a higher return or risk-adjusted return over time than men. So maybe more men should take advice from a woman, could be their partner or friend or whatever.
I have something to learn from my partner, in other words.
Yeah, of course. We have to learn from each other. Investing isn't, you are investing your own money, of course, but I think you should always talk to people around you, men, women with different backgrounds and different kind of skills, because they can help you to up your portfolio.
Great. And we have a question regarding ISK and also the comparison. I think maybe the benefits of ISK and KF, but also if you know something about the new tax rules on ISK.
Yeah, because after New Year's, you're going to get the first 150,000 kronor you're not gonna have to pay any taxes on them, and after a year it's gonna be 300,000. Yeah, we like that.
Yeah,
Great policy.
that's a good thing.
Yeah, it's a good thing, and of course there's a lot of our customers that have more money on this kind of account, and you're gonna save up to 1,300 kronor, I think, and maybe that's not all the money in the world, but I think for people that haven't started to save and invest, I think this is a really great initiative or a great policy to show people that we think that you should invest. Don't borrow and invest in instead. So yeah, hopefully we will welcome more customers to start ISK or KF.
So the new rules basically are just an upside.
Yeah.
Yeah. Great. We also have a question here, which I also quite interested in, regarding stocks and what markets you can invest in. We have some non-European ones, for example, the US and Canada, if I believe.
Yeah, of course.
But markets that is not available on ordering directly from our website. Is there a possibility to invest in those?
Yes, you can always call our traders because we have a trading desk that you can call, and you can get their help to invest in a certain market that you can't find on the web or in the app. Often they cost a little bit more of commission, but if you're really eager to invest in, say, Hong Kong or any other market, please feel free to call them.
Great.
But I would say that if we look at what our customers are investing in, Sweden is the most popular market, and then the US. We have a very large home bias in Sweden, and I think it's the same in other countries when Danish people invest and Norway people and German people. We tend to invest in what we know, and what's in our home market is therefore in all of those top charts.
Do you know which is the third or fourth place in how we Swedes or people here in Sweden invest, besides, of course, Sweden and
the US? I would say Germany.
Germany.
I'm not sure, but I think it's Germany.
All right. So I think those were the questions.
Those were the questions. Thank you for listening in, and thank you, Henrik, for spontaneously coming up here and joining me. It's been fantastic.
Yes, it's been really fun and informative. So thank you for listening in. This presentation will have been recorded.
Yep.
So you can watch it
over and over
again, as many times as you want. And that's about it.
It's about it. Thank you so much and good luck.